capital?
Return of capital.
Return of capital. So return of capital is always more important for an investor than return on capital. So there is a contradictory theory also कि people like us or retail investors like us, they always think of return on capital. Whenever you go or whenever you discuss any idea कि okay यहाँ पे इतना पैसा लगा देते हैं, so first question which you ask is कि कितना रिटर्न आएगा. That means you are talking about return on capital, right? Whenever a institution applies, for that matter, banking structure, we understood that the banking structure has banks income majorly comes from the interest income, so they give loans and then they earn, right? So whenever they give loans, so they don't give it ki like okay 18% return aega. We give a loan to, let's say, Kuldeep, and his profile is not that great, but we can charge higher interest rate somewhere around 18% because he's not getting loans from markets. Whereas in the market, general loans are at 10% or 9.5%, something like that. They're charging double. So they don't think in a way ki we can charge double, we'll be earning higher. They think in a way ki if you're giving loan to the Kuldeep, will he default or not? Will his money, what we are giving as a principal, will that principal will come back or not? That is their first concern. So both the theories are true. The thing is over here, like we were discussing last time, that it is always a psychological and behavioral pattern. We have only this much. This much means we can talk in thousands, maybe in few lakhs. So thousands and few lakhs is something which is almost peanut. In fact, not even peanut, wo rai ka dana, right? Mustard seed. It is like that in finance world. So when we have small, we talk big. But when we have bigger amount, we always talk small. We always become conservative. So whenever we are talking about an institution of, may it be FII, may it be DII, or may it be any institution for that matter, they always think in terms of return of capital first, then they think of return on capital. That means they want to conserve, they want to preserve their capital first, and then after that they want to look into the what returns they will be getting it. So bond market is something like that only. So bond market is something where their return of capital is guaranteed. Majorly they play into the money markets. Money markets are nothing but they have the you can say liquidity, as well as they have the maturity which ranges from 1 day to 1 year most of the time. And major institutions we talk about, may it be NBFCs, may it be
Sir, we
banks,
can't hear you.
Yes,
you
your video was on, but your audio cut off.
audio cut off. Okay. So no issue. So when we talk about financial institutions, or when we talk about the FIIs, DIIs, the bigger investors, they always think of their return of capital first, because for them the conservation of their capital is more important. They would love to miss out the opportunity of gaining high returns where the risk is very high. They would love to miss out that. They always play in certainty where they can see certain results coming out. May it be probable, but still certainty is high. For example, during COVID periods, people pull out money from equity markets first because there was no certainty when it hit, when COVID striked, or when COVID hit to every country. Nobody had a clue how it will go off and how to deal with this situation. So that means there was uncertainty for couple of months, 2 3 good months, there was uncertainty what is going to happen. As soon as certainty came as in ki people knew ki okay, we don't have any medicine for this as of now to deal with it, to treat any patient, but what we have is to cut off that patient, the person who is impacted with COVID, to cut off that person from the herd for good 7 days, then this particular thing can go up, and the person cannot affect other persons with this virus, right? So there was a little certainty ki, okay, now we have a way to deal with. So again, money started coming back to the markets for the investment. So basically, when your funds are very large today, when you have funds of, let's say, a couple of thousands or maybe couple of lakhs, you can easily think of कि ठीक है यार 5 लाख रुपए हैं, 2 लाख लगा देता हूँ, आया तो आया, गया तो गया, कोई बात नहीं, because 2 lakh is the amount which you can earn very easily when you get salaried. So that amount becomes like okay, ठीक है, कोई बात नहीं, सैलरी आ रही है ना, अगर मेरा 1 लाख रुपए चला भी गया तो 2 महीने की सैलरी, 3 महीने की सैलरी में कवर अप हो जाएगा. I can take that risk. But when I add crores behind your fund, let's say you said 10,000, I said 10,000 crores, then you will think of it, 10,000 crores है boss. अगर इसमें से 5,000 करोड़ उड़ गया तो मैं आधा उड़ जाऊंगा, right? That's a big amount. So as soon as your amount goes big, your thought goes conservative. So bigger boys or big boys always think in terms of certainty. Return of capital is more important for them, so they participate in bond markets. Now when bigger boys or big boys for that matter are participating in bond markets, that means the major diversion in the equity market also takes place from bond markets. How bond market is going to behave, respectively the equity markets will behave. So first impact is seen in bond markets. That's why the yield curve inversion, do you remember, we have read yield curve inversion? We have read or not? Everyone remember? Elster, you looks confused. No.
Yield conversion, na?
Yield curve inversion.
Yeah.
We have not.
I don't think we have done
No
that.
problem. So no problem. We'll cover up this in this particular topic only. I'll make you through. So you have heard about yield curve inversion? Not. Okay. So whenever any country or any economy is being said that the country is going in recession, the first indication or the major indication is yield curve inversion. If yield curves get inverted, in that case, we can say that the country is going on recession. For as of now, you can just write it down, this particular statement. What exactly it is, we'll study in this particular bond segment only. So now, when we are talking about the bonds, the fixed income, so big boys always play for the certainty. So if your bond market is giving you somewhere around 8% or 9% of returns, which is guaranteed. If a government bond is guaranteeing somewhere around 8% of returns, and equity market is has an average return of 12 to 15% CAGR, what we talk about. So big boys always prefer to have 8% guaranteed or 8% with certainty rather than having a 12% or 15% with uncertainty. So when your bond markets is giving you higher returns compared to equities, higher returns compared to equities does not mean that absolute number is higher. Higher returns compared to equities means risk reward ratio is higher. So here in bond markets, their risk is almost zero and they are getting 8% of return. In equities, they're getting 15% of returns, but their risk is almost equivalent to 15%. That means they can go down also, and in a big way. So they will always try to understand where the risk is less and return is high, and where the stability is more, where the certainty is more, they put their money into it. So when rates are higher, they put their money, they shift their money to the bond market. When rates started reducing, at that time equity markets start increasing. How that happens is, current scenario, everybody is aware that we are high on the interest rates. Right now, RBI has not increased rates for this quarter. For last quarter also, they have not increased rate. But from 2021, if I have to see, or rather 2020 or somewhere around October, if I have to compare, we are almost 4% up for what we have at that time. Almost 4% up. If not 4, at least 3.5%, something like that. At that time, we were having a repo rate of somewhere around 4%. Right now, we are having somewhere around 7.5. To be precise, it is 7.16. Right? So that is the 10-year bond yield as of now. So that means we have come up on the rates. If RBI has increased the repo rates, definitely banks also have increased the rate of fixed deposits. To be competitive and to raise funds, bond market also has to raise the funds, raise the rates. Bonds which are issued already, they cannot raise the rates. So what happens is their yield changes. As of now, keep this yield word with you. I'll yield word with you. I will explain what exactly it is. But the thing is, yield as of now, to understand it, make understand in this way that what is the net effective income of an investor, that is yield. Interest rate could be anything. If I'm saying I'm giving 10% of interest on a bond, that means you will be getting 10% interest. If you put 100 rupees, you will get 10 rupees in your account as an interest. But I'm saying that yield is 9%. That means effectively what you earn is only 9%, which means to procure bond, you might have to expense out something. 1 rupee you might have to expense. So basically what your transaction is, 100 rupees is a bond price. You expense out 1 rupees and you are getting 10 rupees. So minus 1 plus 10. That means you have effectively got 9. 10 rupees comes to your account every time. but effectively you have got only 9 rupees because you have expense out 1 rupee to procure that bond. So effectively your income is 9%. So that is called yield. What effective amount you are getting, not real amount. What effective you are getting in your hand, that is your yield, right? So when yield rises, so that means yield is rising. That means you are getting good amount of returns with a great certainty. So you will always try to move that side. And when these interest rates rise, when there is a crisis in the economy, to control those crises, interest rates rises. And now the control those crises means the bigger crisis which comes up is inflation. How does inflation rise? So this is a cycle, completely a cycle. Growth, inflation keeps on going with parallel to each other. If one is going up, definitely other has to go up. But to control both, the RBI has a three balls. So RBI is a juggler with three balls. It has three balls in his hands. One is interest rates, one is growth, and the third is inflation. So RBI keeps on juggling. So at a time, one thing RBI has to keep on toss. If RBI is controlling growth and inflation both, then interest rates goes on toss. If RBI is controlling interest rates and growth, then inflation goes on toss. If RBI is controlling inflation and interest rates, then growth goes on toss. So one thing is always in air. RBI can control two. So when we replace RBI with a central bank, so it covers every country. So every country's central bank has three balls. Out of three, one ball is in air. That means it is on toss, cannot control. So practically not possible. Now, how these three balls are correlated with each other? Who is the biggest borrower in the country? So there are three types of people. One is retail investors like you and me. Correct? We will borrow at max what we can borrow for home loan, for personal loan, which can be as per our income cycle, few crores, not more than that, right? Then there are, you can say government who's borrowing. The government always borrow on a higher side, but government does not borrow from the banks. Government has a borrowing from other aspect, which is majorly from the bonds, and they get dividend income. Correct. Third is the corporates. Corporates borrow, they are the major borrowers because they always borrow for a corporate activity or a commercial activity. And with commercial activity, what exactly they achieve is they achieve the growth of the economy. Correct. So when they are borrowing, so they are what exactly doing is they are coming up with some capex, capital expansion of their plants. Maybe they're increasing their for IT industries, they are increasing their manpower. So they will have to shell out more money in this form of salaries. And for projects, definitely they are coming up with more projects. So they are consuming a lot of commodities and something like that. So corporates are always borrowing to grow, and when they are growing, then economy is growing. For that matter, presently most of the corporates in India are almost at their 80% of the capital capacity utilization. What does that mean? If I am saying ki most of the corporates are at their 80% capital capacity utilization, that simply means if they want to produce more, if they want to grow more, they have only 20% of the scope. Correct. If they have bigger plans of expansion, then definitely they have to borrow more and they have to expand more. They have to increase their capacity. Correct. If right now their capacity is 100 and they are utilizing 80 out of 100, so they are left with only 20. That means if they have future plans to expand out drastically, so they have to expense, they have to expand their their utilization capacity. So they have to build more. If for that matter, yeah, for example, if we take steel plant, it is producing 16 million ton as of now. The capacity is somewhere around 20 million tons. If it has achieved 16 million tons, so it can achieve 20 million tons in a very short span, maybe a year or maybe 2 years, not more than that. After that, what it will do? It cannot produce. It will, the growth is stagnant. Neither the company will grow nor the country will grow, whereas demand from the individuals is growing. So what it has to do is it has to expand its plant, expand its capacity so that it can bring more, it can produce more. So they will start planning to expand. Till the time they come up with 20 million ton, they will already have expanded their plant capacity to somewhere around 30 million tons. So that means if they've reached to 30 million ton capacity, so they and they're using 20 million ton as of now, they are utilizing 20 million tons. That means they are utilizing somewhere around 67%. So from 80% they went to 100%, but in actual they came down to 67% because they have expand out it. To do this, they need funds, which is a bigger funds, and that is called an capital expansion, capex in short form. You might have used this particular capex word in accountancy also. So this is what is capex called as. So they will be borrowing a lot. When interest rates are high, will they borrow at that time, or when the interest rates are low, they will borrow more?
They're
When
low.
when low. So when interest rates are low, they will borrow more. So the interest expenses will be less from their pocket. And this interest rate fluctuation keeps on coming and rising. So when interest rates are low, they are borrowing more. When they are borrowing more, what they are doing is they are doing expansions. So when they're doing expansions, definitely they are giving lot of jobs. They are creating lot of jobs. Correct? If presently they are giving jobs to 100 people, and with the expansion plan, they are definitely giving at least 10, 20, 30% more jobs. They are creating more jobs, what they already had. More job means they will be giving salaries. So retail people like you and me will be having more income. I might be doing, for example, right now I'm having my job with a bank, as well as with my own extra time. I'm using this extra time over here. Economy for us is doing decent. It is doing good. So I have some extra time which I'm using over here. So I'm doing double time. I'm getting more income. But on the contrary, if the world out there becomes competitive and incomes are not coming to the corporates, then there's a sword which is hanging on our head that we can lose our job, right? We can lose our job anytime we can be drawn out of the job ki theek hai aaj ye 500 log inko nikal diya, usme mera number bhi aa sakta hai. So for that, what will I do is, if I'm working right now 10 hours, I might started working 16 hours, 17 hours, so that my boss thinks he is a hard worker, I should not leave him. Correct? So I will give my extra time over there to save my job. That means if I'm giving extra time, definitely I'm expending something out of my pocket, maybe on medicines, maybe on my health, maybe on the other things from where I can meet up targets and I do better so that I can survive in my job, right? So this I can do. I will not be having extra income, so I will not be spending out. But here, when interest rates are low, jobs are the people who are doing job, the already having job, their job becomes little easier compared to the safety, and other people also start getting more and more jobs with respect to the other scenario. So what happens is the money they get more. People who are not getting anything, they started getting jobs, so they also get money. When there is surplus money or surplus funds in our hand, what we do with that funds? Let me have your views. So from Suraj, we'll start. Suraj, if you have surplus money right now, you are in college. Let's say from tomorrow onwards, you start getting 50,000. So you are already filthy rich. Whatever you're getting it, additional 50,000 is started coming to your account per month. What will you do with that 50,000? Don't tell me
Long term,
invest.
long term
Don't.
investing.
And my investment is not an option because I know that. So leave that investment option. Now tell me, what will you do?
Investment is not an option.
Ah.
Sir, maybe hobbies को पूरे करने के लिए travel and
Correct. Shireen ma'am, what will you do?
मैम सॉरी सर फूड के उस पे
Food के ऊपर.
हाँ
Esther, what will you do?
So is trading an option?
Trading an option? Yes, you can take that.
I
Hardik?
would start trading.
Okay, you'll start trading. Ananya ma'am, what will you do?
Sir, I'll trade and I'll also use it for studies.
Use it for studies. Okay, you will try to get more higher degree from the much better college where the fees is more. We have one more person, na? Ayan, is he there? Ayan,
Yes, ma'am. Yes, ma'am.
what will you do?
Start buying asset and give it for like lease.
Again, investment is not an option. Then what will you do?
So not
Okay.
any investment. Like I'll buy any asset like house or cars and
House
and I'll
and
give it
cars.
for
Hmm.
give it for like rent.
Correct. So basically, what happens is majority of the time we start asking for luxuries. Luxuries are the things which we could not afford at the time when the money, the incoming of the money was little difficult for us. We start asking those things from the market. So in turn, we actually start asking things which are not available, or which are which were not available in abundant, which have a limited capacity. So till now, my company was producing only 16 million ton, and the demand from the market was also somewhere around 14-15 million ton. Let's say 13 million ton for that matter. When we start getting money, we start demanding steel. I'm taking the example of steel only, or let's take example of phone over here in that case. Till now, the phones were 16 million phones were being produced. Apple phones for that example, Apple phones, 16 million phones were being produced. 13 millions were was the consumption. 3 million was surplus. It was exported or sent to the other country. But now what happens is we all are getting rich by 50,000 every month, so we can afford phones, right? People can afford two phones also. Few people must be like very कि एक से मैं videos बनाऊंगा और एक से मैं बात करूंगा. It could be possible because अमीरी आ गई है, तो we people do stuff like that. So Apple phones का demand बढ़ गया from 16 million, it went to let's say 18 million. Now 2 million is already a shortfall. Previously we were at somewhere around 3 million surplus. Now we are shortfall of 2 million. So components which are helping us to produce Apple phone or to manufacture Apple phones, the scarcity of that will start going in. Like chips, we have an example, right? So these things start getting costly. In the same way, presently, if we talk about then commodities, which is the vegetables like tomatoes, those are getting costly because we are not having a good produce, or whatever produce is coming up, that is getting bad, and we are not. It's not usable, has to be thrown. So basically, demand started rising, but production does not. So what comes up is inflation. So as interest rate comes down, growth start picking up, and with the growth, inflation goes up. So inflation to certain level is good, which is supporting your growth, because if inflation comes up, that means demand is going up. If demand is going up, that means you have a scope of growth, because till now we were producing 16 million, now we will start producing 18 million. So we are growing now, right? Certain extent inflation is good. Now what is that extent? For RBI, that extent is 4 plus minus 2. That means that is the bracket where RBI is okay to deal with inflation. 4 plus minus 2 means, yeah.
So can you repeat what you said? Your voice cut off for me. I couldn't
Okay.
hear you properly.
So
What is that?
yeah, so I'm saying ki whenever inflation is coming up, so inflation is actually pushing growth, because inflation is coming up because of the more demand. If demand is more, then definitely the companies or the corporates have to produce more. That means they will grow more, right? So growth and inflation are coming on parallel track, whereas interest rate is inversely proportion to inflation and growth. Inflation rate rises, people will start producing less, and because of which the demand will also start going less, because if the corporates are not producing more, they will have more layoffs. If more layoffs are there, the people will not have salaries, and if they are not having salaries, they will stick to the basic. Okay, let's have only basic, let's survive first, we'll think of luxuries later on. So things are related like this. So if inflation is rising to certain level, inflation is good. That's why inflation should be there in the economy, because inflation brings growth. But RBI, a central bank, their role is to control inflation, control growth, and control interest rate. So out of three balls, one ball always remains tossed in the air. So if inflation has gone for toss, that means if inflation is in the air and if inflation is shooting through the roof, then growth will be impacted very badly, because to control it, then interest rate have to be risen. Interest rate will start rising and growth will start coming down automatically, right? So RBI says till inflation is between is in the range of 4 plus minus 2. 4 plus minus 2. Let me write it down over here for you guys. I'm already sharing new share. May I will open up just a moment. Is this page visible?
Yes.
4 plus minus 2. This is the range which RBI is comfortable with. That means from 2 to 6%. from 2% to 6%. This is the bracket where RBI is comfortable. So right now our inflation is just below 6%, but RBI says that we will bring down this inflation rate to somewhere around 5%, because that is something controllable. Now just imagine ki RBI is standing there with 3 balls, 2 in hands, 1 is in the air, RBI is juggling. Now that juggling is not that fast what you see with the jokers, right? The juggling is ki they have tossed one ball is in right hand, one ball is in left hand, other ball is going, it's going high. Now it has a frequency. Let's say that every 3 months this ball changes. So that means the ball which is on toss, it has to come down in 3 months. If it is not coming down in 3 months, it will disturb the pattern completely. Correct? And which is happening right now. The inflation went up and it has disturbed the pattern. So RBI tried to juggle these 2 balls but could not sustain, because that ball, it has gone out of control. It is coming down in 3 months or 6 months, they are still not sure. But their hands are automatically moving, right? So they are not able to do that. So ultimately, they might raise for other ball also in the toss. This is just an imaginary explanation, but the thing is ki they have to keep control of it. So inflation, when it goes beyond 6%, that goes little out of comfort zone. So it feels difficult for them to bring down all the things in a proper way. So they always try to bring inflation in control. So during COVID periods, people were at home, and there like a lot of people were getting salaries, a lot of were not getting at all anything. So people who were not getting salaries, they were, we can say, somewhere around the poverty line, near poverty line, or average, just average above the poverty line, or maybe below poverty line. They were not getting salaries and they were kicked out of their jobs. They went home with nothing. Correct? But people like you and me, what we had is our salaries were coming. We were working from home. So automatically luxury expenses cut down. We didn't have anything else to do because we could not go out. Second thing which happened was that we were only living on the basics. And the second thing which happened was ki if we had loans at that time, interest rates also dropped drastically by 2 to 3%. That means if you were expensing out somewhere around 10 rupees or somewhere around 100 rupees as an interest expense, if we have loans, that interest expense came down by some, let's say 10 rupees or 20 rupees. So that 10-20 rupees was also a saving for us. Correct? So our
So,
salary.
your voice was lagging for me. Can you rewind a bit, like from the
Okay.
loan part?
Okay. So during the COVID, we had advantage of 2 things. One is we were having salaries, correct?
Yes,
And
sir.
no
Yes.
expense at all. We were
Mhm.
expensing out only basic things because we were not getting anything else. We were not going out every week. We were not
Right.
boozing too much. We were not going for a luxury drive or something like that. No luxury items, nothing.
Right. Hmm.
Correct? So expense were reduced and salary was same. So we were saving more at that time. Secondly, if we have loans, so interest rates of loan came down drastically. So interest expense, which was supposed to go out of our pocket, that also reduced. Not only that, but also government gave a window of 3 months to 4 months or 3 months to 6 months, that at this particular time tax holiday, interest holiday they gave us. So that for these 6 months, we will not be paying any interest or any EMIs for that particular time period, right? So we got
Yes.
another money which was not supposed to be saved. We got that money also saved. So what people did is what Elsevier was thinking: start trading. So they started infusing that money where in the equity markets, because they didn't have anywhere to go out. So equity markets shot up like anything, because of this surplus money. Equity market started shooting up something. So Suraj also put his money into investments, not maybe directly the stocks, but in the mutual funds. So mutual fund inflow, SIP inflow also started rising. Right now we are committing somewhere around 15,000 crores per month as SIP. 15,000 crores per month, which is highest ever. Every month 15,000 crores of funds are going into the equity markets as SIP. 15,000 crores. We always think कि मेरे 500 रुपए से क्या होगा, आपके 500 रुपए जोड़ के 15,000 crore हो गए. Whereas if we go couple of years back, in fact almost 2 decades back, so we'll see that 15,000 crore was a full year. It was full year's inflow. Now it is 1 month's inflow. And in fact we are little higher than that. Things have changed. Now people have started investing. Now, as soon as COVID was open, what people did was people started rushing to restaurants, started rushing to hotels, started going for destinations, started going for vacations, started asking for luxuries. So what happens is inflation shot up like anything. Inflation shot up because people were very much accustomed to it that they have to spend out less. इंटरेस्ट लोन का देना नहीं है, सैलरी इतने महीनों से बचा के रखी है, इक्विटी मार्केट में भी पैसा बना लिया, whatever we put into the equity market also gave us good return ranging between 40 to 100%. Few people make 100%, few people make 40%, few 60, few 80, but most of the people made money in equity market. So now they have abundance of money. अब करें क्या, आगे का तो प्लान है ही नहीं. So they started expanding left, right, center. They started demanding luxuries. So inflation shot up. Now inflation is at peak. And to reduce that inflation, government started rising rates again. So rates बढ़ने लगे. जो लोन का हॉलीडे मिला था इंटरेस्ट का वो मांगने लगे. उन्होंने बोला कि जो हॉलीडे दिया था अब उसके ऊपर भी हम इंटरेस्ट लगा के देंगे. दैट ऑल्सो बिकम अ लोन. तो अब आपकी जेब से एक्स्ट्रा इंटरेस्ट जाएगा. जितना छूट दिया था यू हैव टू पे बैक अगेन, राइट? So now expenses out of the pocket increased drastically. So people stop demanding luxuries. Now again they are going back to the luxuries or going back to the necessities. But on the parallel side, when inflation was rising, growth was also rising. So salaries also started getting higher. So basically till now money is compensating. So till now inflation has not come down because if expenses have risen, the salaries or the income has also risen parallelly, and that too drastically. So people are demanding more and more and more, right? This is happening. Now, all these things, when we look into the economy, so when we have to be cautious is that we look into the bond side, what bond market is actually doing. So whenever interest rates are rising, what big boys does is they go for bond market, they go for safety because they know that the turmoil is coming in the markets and this turmoil can wipe their capital down by 30, 40, 50%. So they always make themselves safe from that particular turmoil and they avoid that particular turmoil and they don't participate in equity markets at that time. They pull out money from equity markets for that time. They put their money into the safe zone, which is the bond markets. And as soon as they feel that, okay, bond market is now settling down, it is not rising any further. And if it is settling down, that is in turn correlated to the equity markets. If bond market is settling down, then equity market will again start rising up. So they start infusing slowly and gradually to the equity markets. This is how this cycle completely works. Is this clear till now? ऊपर से तो नहीं गया? Okay, and since your video is not on, so I am not sure if you are getting it or not. So at least voice, at least your words would say if you are getting it.
Yes, sir.
Great. So now bond markets are the major indicator about the economy's health. Though we always judge it from the equity. Why? Because the major problem with the bond market is that it is not that liquid as equity market. What does that mean is, today if you buy a share, equity share of your Reliance Industry, for that example, let's say you bought 100 shares at the rate of 2500. Tomorrow if it goes down, let's say till 2000, you say कि नहीं 500 रुपए से ऊपर का मेरे को ज्यादा वो नहीं लेना, 50,000 loss is a big loss for me. Let me sell it and bring back my money. At least your capital budget, let me bring it back. So you will find a buyer to whom you can sell. Find a buyer, that does not mean that you have to go in the market and start shouting that I have Reliance share, I want to share, I want to sell. No. Find a buyer means online only. If you put your bid, there would be someone to buy that particular stock, right? But in bond market, and your order can get executed with you can say in seconds, in microseconds, or maybe in couple of hours. If you're not having that buyers available at that particular price, maybe at some lower high you might get that buyer. If you want to sell at 2000, maybe you might find a buyer at 1980 or 1950, something like that, and you can at least sell and exit. In bond markets, that's not the case. In bond markets, what happens is ki if you have bonds, you might not get buyers for a couple of days or weeks also. Might not, because it is not very famous. And in bond markets, who are the people who actually invest? Actually, the big boys. Big boys means corporates, 500 crores, 1000 crores, 100 crores, 80 crores, 200 crores, like that. right? And they don't invest in bond markets for the purpose of returns. They invest in bond markets majorly for two things. One is to park their surplus money for which they will be using at some other time. They know it, they want to use this money after 2 years for expansion. Let's say they have a plan of expansion and they are having money of somewhere around 500 crores and the total plan of expansion is 500 crores. But as per their treasury calculation, this 500 crores will be used in phases. So every year they will be using 100 crores. Every year they need that money. So what they do is for first 100 crores, they will keep it in current accounts only because for this year they need 100 crores. They will use that money into it. Then they will put 100 crores in the bonds, which is a maturity of 1 year, another 100 crores with a maturity of 2 year, another 100 crores with a maturity of 3 years, another 100 crores with a maturity of 4 years. So all this money will be placed as per the maturities. Now, do they need that money in between? No. Is their money earning them certain interest? Yes. Do they need more interest on this or more return on this? No, because their purpose is not to earn extra income onto it. Their purpose is to preserve this capital so that they can use it at a particular time period. So bonds is the best. If they are investing into government bonds with no expectation of the higher returns and with certainty that they will get their principal back on a certain date, they will happily invest into it. So they stay invested into it. Now, when they have bought a bond, parallelly, if let's say they have bought a bond of 10 years government G-Sec yield, 1000 crores is the you can say band which has come out, and out of 1000 crores, 999,000 crores has been bought by someone else, or maybe one particular 1 CR bonds has been bought by you all five, right? 100 crore. Now you want to sell it. Who's going to buy? Nobody is there. They are not interested. They had money, they infused it. They are not interested into it. The retail investors, you're not finding it easily. Maybe I would be interested, but not now. Somewhere later in the time, I will wait for it. कि हाँ, ठीक है, आज नहीं buy करते हैं, कल buy करते हैं, परसों buy करते हैं. You are selling it at 100 rupees. I wanted 90 rupees, 80 rupees. So this is the gap. The gap of the prices is too much. Liquidity is very less. Participants are very less. So that's why bond has a problem. The liquidity is a major problem of dealing with it. So you don't get much out of it. So that's why people avoid bonds, or rather I would say people are not having much information about the bonds. Here in bonds, how the things are get controlled is interest rates when rises, it gives a different perspective to the yields. So let's take an example on that. First, understand what exactly we are trying to take it for. Markets for trading government bonds, what actually the bond market is, where these bonds are what you can say traded. So it is traded in the bond market. They are also the dematerialized form. They also come to your account as a dematerialized form now. Previously, they used to come in the form of physical bonds. Now they are coming into dematerialized form. So this is the market. Bond market is a market where government bonds, corporate bonds, and tax-free bonds are traded. Every type of bonds are traded. That is a simple market. And fixed income instruments, they are less volatile. Their rates does not changes very drastically. Their rates stay for long unless your interest rates are changing, because they are directly related to the interest rates. If interest rates are rising, then the present bond will be less popular and the new bond will come into the picture. Because if government has issued a bond, we have understood this thing earlier, ki if a bond has been,
So
yeah,
when you say interest rate, it means interest rate of other products, or not the bond, but the economy in general, right?
economy in general, correct.
Okay.
Because your interest rates are governing all your investments. If you are getting, again, this thought is always there, that if you are getting a higher interest rate with a certainty, you will not love to put your money into something else. Correct? जहाँ पे certainty ज़्यादा, risk and reward, where your risk is very less. If I'm saying you put your money into FD or RBI government bonds where you're getting 8% of return, RBI government bonds is the safest. G-Sec, government securities, those are safest. If that is giving you 8% of returns, and I say you put your money into the equity markets, you'll get 12% of return CAGR. That means, and you have to keep your money for 5 years. You'll say, why would I keep my money for 5 years for a CAGR of 15% or 12% where there is no guarantee? It is quite possible that next year my funds would be down by 40%. I will be in tension. I might not be able to handle that 40% downfall. Take that example of 2019, 2020 March. My funds were down by 50%. I might not be able to take that tension कि मैंने 1 crore लगाया 50% down हो गया, right? I might not be able to handle it. But in government bonds, I know कि if I put 100 rupees and I am getting 8 rupees as a interest, this is fixed. This will keep on coming irrespective of what is happening unless RBI is going to default. If RBI is going to default, on a lighter note, मैं पैसे का करूंगा भी क्या? मेरी पूरी की पूरी इकोनॉमी डूब गई तो वो पैसा मेरे लिए कागज है और कुछ नहीं. द पैसा, दैट मनी इज ओनली अ पीस ऑफ पेपर, right? This, it's of no use to me. So when I am getting a guarantee, a sovereign guarantee, why would I put my money somewhere where I don't have any guarantee, where I am looking at the conservation, the preservation of my capital, right? So interest rates, when they start rising, so what happens is the bonds which are already issued, because once a bond is issued, nothing can be changed except the principal. Now let's understand this thing with example. Let's say is let's take my company's name, though it is not liable to issue a bond. Mudaksh bond, 9%, 2030, with a yield of
So 9% is a coupon rate.
coupon rate. Coupon.
Right?
I'm just explaining. I'm just explaining it. Right. So majorly this is your coupon rate. 9% is a coupon rate, which is the interest rate which you'll be getting. This is maturity year. So let me put it completely March 31st, 2030. This is the time when my bond will get mature. And here, let me write it down, 10 lakh rupees. This is the face value of the bond. Face value we have read, and everybody remembers. Terminologies of bonds we have understood, right? So this is the face value of the bond, which is 10 lakhs. This is the coupon rate, which is also called as interest. Why it is called as coupon rate, I have explained. Ayan, you were there in that class?
I think no.
You think no? Okay, so let me take an example. Or somebody would like to explain by the time I open Excel sheets?
So basically, coupon is back then when we used to have the papers, we used to have like small bits of coupon rates where we could go and claim them. So like we had to cut them every time we use. I don't know.
So we have like एक ईयर का 12 कूपन्स मल्टीप्लाई बाय जितने ईयर्स हैं तो उसका अलग अलग 1% का वो रिप्रेजेंट करता था.
करेक्ट. आयान समझ में आया? अभी नहीं आया तो इधर देखो. पहले जब होता था बॉन्ड्स ना, तो पहले बॉन्ड्स फिजिकल फॉर्मेट में आते थे, राइट? सो लेट्स से दिस इज द बॉन्ड. यहाँ पे पूरे बॉन्ड की टर्मिनोलॉजीज लिखी हुई है. नाउ हाउ मेनी rows we have? We have 1, 2, 3, 4, 5, 6, 7. 7 rows and 3 columns. That means 21 coupons. Let's say this bond has a maturity of 21 months or 21 period, 21 years or 21 months or whatever it is. So what happens is, this is the bond. Whenever you want that interest of that particular bond, you have to tear out one coupon out of it and go to the bank and present that coupon, that this is the coupon with me, this is the bond with me, give interest of this particular bond to my account. So you will get interest into your account. So you always have to tear out one coupon from the bond and present it in the bank to get that interest. So that's why it was called as a coupon rate. And till now it has been the terminology has not changed. It is still called as a coupon rate. Now thing is ki now bonds are dematerialized. They don't come in the physical form. They directly come into your demat account. So there is no question of coupons to coming to your account or coupons coming to your hand. So you get directly this 9% interest in your account. Better? Ayan?
Yes, sir.
Okay. So this is called, but still we use the terminology as a coupon rate. We don't say interest. We always say coupon rate. So whenever someone says coupon rate, that means that is the interest we'll be getting it. So 10 lakhs, Mudaksh bond 9%, March 31st, 2030 with a yield of 8%. That means face value of the bond is 10 lakhs. Company who is issuing is Mudaksh, whatever the full name is. then 9% is the coupon rate. That means this is the amount of interest which will be credited to your account, and this is the date of maturity. On this date, you will get back 10 lakh rupees, because 10 lakh rupees is the maturity amount, face value, and this is you'll get it back at the time of maturity. Yield is 8%. Now, what does that mean is, so that means, let's say my IP, which is interest payment, is yearly. So right now we are in 2023, 31st March has gone. So in 24, we will be getting how much money? 90,000, because 9% of 10 lakh is 90,000, and interest will be paid on which date? 31st March 2024, right? Guys, with me or not?
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
Great. So you will keep on getting these interest in your account till 2030. Got it? 24 में भी मिलेगा, 25 में भी मिलेगा, 6 में मिलेगा, 7 में मिलेगा, till 2030. On 2030, 31st March 2030, you will get 90,000 plus 10 lakhs also, right? Here I have to put plus. Basically, on 31st March 2030, you will be getting 10 lakhs 90,000. This will be the net amount. Now, when I say yield, as I explained in a brief, that yield means net effective kitna hai aapke paas. Here we are getting 90,000, correct? Net effective, if I say that here, how many years we have to keep this bond? We have to keep this bond for 7 years. So let's say I bought this bond at 10,70,000. To buy this bond, I have expense out 70,000 extra. This 70,000 was my extra expense, which I will not get, because at the time of
Premium.
maturity, sorry,
Premium, 70,000 is
premium, correct. So this 70,000 is the premium which I have paid to procure this bond, and at the time of maturity, I will be getting only my face value back. This premium I will not be getting back, right? So what happens is, this is the extra expense out of my pocket, and it will reduce my overall income. So overall, I am earning 90,000 every year. But if I divide this 70,000 by 7 years, because I'm keeping this bond for 7 years, so every year 10,000 is the amount which I've expensed out on an average. So that means my net effective earning from the bond is how much? 80,000 every year. So my yield goes down to 8%. Is it clear? Everyone? Okay.
But sir, it happens only in the case of premium, na? कि yield
नहीं,
नीचे जाएगा.
In discount, your yield will increase.
हाँ, in discount yield will increase. Yeah.
हाँ, तो अभी अपन वही सिनेरियो डिस्कस करेंगे. So when I'm talking about the bonds की bond market से हमें कैसे इंडिकेशन मिलता है, that we'll discuss over here. Now here yield, this is just an explanatory. Yield थोड़ा सा और डिटेल होता है. When we will discuss about yield in detail, I'll tell you what exactly this means, how to calculate it, right? We'll do the calculations. I'll tell you this is the simplest thing, but there are other assumptions also which are taken into consideration. But as of now, just understand that net effective what you are getting in your hand, that is your yield. This does not mean that you will be getting 80,000 in your account. This only means that is a net effective in your hand. You will be getting in your account interest, which is your coupon rate. You will still be getting 90,000 in your account. But since you have expensed this, you have already spent 70,000 already. Because while procuring this bond, you have paid 10,70,000. So your expense has already gone out of your pocket, right? So this expense has already gone out of your pocket, and you will be getting 90,000 only in your account. This is the calculation to understand what is the yield. And yield is nothing but net effective what you're getting, right? Now, when interest rates in the economy are rising, this is, let's say, ki when this 9% is the bond yield. So at that time, repo rate is, let's say, somewhere around 8%. I'm just taking an arbitrary example. Repo rate is nothing but the RBI's rate, right? On which the banks lend. RBI lends to the bank, and bank repo and reverse repo, the lending and the reverse lending from the banks, amongst the banks in the RBI. Now, this is the case. Let's say case 1. Repo increases to, let's say, 10%. Now, if repo is increasing to 10%, definitely the interest rate of the fixed deposit will increase. bonds, how much safer they can be, but still they have a probability of going to default. It could be 0.000001, but that probability is also there that a company, a corporate can go to default. In that case also your money can go to default, right? Same thing. Second is key, this bond, I cannot change anything in this bond because coupon rate, this is fixed. I cannot change this. This has already been issued. This is a commitment by a company. Maturity, this is also fixed. I cannot change it. What varies is yield. How does it varies? With respect to this premium or discount. If I am buying it at a premium or discount. Now, when repo rate increases to 10%, now tell me, will you go and buy this bond at 9%? It is giving you lesser interest rate compared to what RBI is giving. Mudaksh is a company. It could be AAA rated, but can it beat RBI? No. So we always prefer to go on a safer side. So RBI is something we will prefer to go. When we are talking about RBI, which is giving us 10%, so will this be my favorite or not? Definitely, this will be my favorite investment instrument. So the demand of this bond will start reducing. When demand of this bond will start reducing, so what will happen is this premium what we have given, this will start reducing. So let's say that this bond is being traded at 9,80,000 now, right? Instead of 10 lakhs, it is being traded at 9,80,000. That means it is being traded at 20,000 discount, which means if I buy it right now and keep it till maturity, how much amount I'll be getting it? I'll be getting 10 lakhs because face value is 10. So if I keep it, I will get 10 lakh rupees at the time of maturity. Correct? That means I've earned 20,000 extra. So 90,000 is my interest, which will keep on coming. But here I've earned 20,000 extra. If I divide this 20,000 by 7 years, that means I got somewhere around 3,000 per year extra, which is 0.3. So my yield goes from 9 to 9.3%. This will be my new yield. Is it clear? Understood? Because interest rate rises, demand of this bond reduces, because of which this bond was being sold at a discount of 20,000, and at the time of maturity I will be getting 10 lakhs only. That means this is a 20,000 which I will be earning. Correct? That will be my earning and that will add up to my yield.
So 10 lakhs plus 90,000, right?
10 lakhs
Interest
plus
is the
90,000
same.
would be the last amount. So 90,000, so you are getting it every year as an interest and plus 10 lakhs. So 10 lakh 90,000. This is the amount you will be getting on 31st March 2030 in any case. Any case, this will be the last amount you'll be getting. Because face value
Yes, sir.
will be given it to you whether you have bought the bond at premium or discount. You will get the face value back as well as you will get the interest rate. Got it? Okay.
Yes, sir.
Now let's take a second case. Repo reduces to, let's say, 8% from 8 to 10. So let's tell me.
Can we get a small actually need to refill my water?
Sure. Okay. So let's take a break for how many minutes? 5 minutes, 7 minutes? How many minutes you want?
सर 5 minutes ले लो क्योंकि फिर लंच का टाइम भी हो जाएगा.
चलो
Yes.
ठीक है. 11:45 we'll meet. ठीक है? चलो. Okay. Okay, so in case one, what we did is when interest rates are rising, so what happens is the existing demand of the current bonds reduces. Simple reason is if you are getting higher returns in short span of time, why would you choose something which is giving you lesser returns in long span of time, right? Case two, when interest rates are reducing, so which will be now future aspect, because what RBI is trying to do is RBI is trying to reduce the rate. Not only RBI, every central government is trying to reduce the rate. So here, if repo rates comes down to 6%, in that case, this particular bond will gain lot of popularity, right? Because it is guaranteeing you 9% of return. This return is guaranteed. Am I right? This will not change. This will be there. So what will happen is everybody would rush to buy this bond. So till now, if you are buying this bond at 10,70,000, now you might find this bond at let's say 11 lakh rupees also. The premium will keep on increasing. Now, because of increase of the premium, this yield will change. Till now, you were spending how much? 70,000 to procure this bond. Now you are spending how much? 1 lakh.
1 lakh, yes, sir.
This 1 lakh will not come back. So this is because of change in repo rate, your bond yields changes. Bond yield changes, not coupon rate. Coupon rate is fixed, maturity is fixed. These are the contractual terms which the issuer has fixed. This face value never changes. This interest rate or coupon rate never changes. This maturity rate never changes. These are the three guiding principles or contractual terms which will not change. The only thing which changes is this yield, and this yield changes on the basis of whether you have bought it at a premium or you have bought it at a discount. Now this premium or discount depends on what change in the economic rate or repo rate for our Indian aspect. So whenever repo rate is falling, in that case, bonds which are having higher maturity with a higher yield will always be favorable and in demand. A lot of people would like to buy and keep higher rate. Now, consider a scenario. This is a I can say a partially homework for you guys. I'm just telling you what exactly I'm going to explain. Somewhere around in 1993, FD rates were 12.5%, somewhere around that. Fixed deposit rates. You can find it out maybe a little later than that also. And in 2019, pre-COVID, FD rates were somewhere around what percent of rate? They were, I guess, 5% or 5.5%, something like that only. Fast forward to 2023, right now we are having fixed deposit rates of how much? 7 to 8%, because repo rates are rising. Now, from 93 till 2019, what happened is that interest rates, that means repo rates, have come down, whereas economy has grown. Correct? We have grown to the mark of 2.5 trillion. Till 2019, 2020, our economy size was somewhere around 2.5 trillion. Right? Right now, we are standing at somewhere around, our economy size is somewhere around 3.5 trillion. And by 2027, we will be 5 trillion. These are not the figures which I am giving it to you. These are the economic figures. So our economy size by 2027 will be 5 trillion. Now, if I see here in 1993, we were less than 1 trillion. Now, provided COVID might not have come, so यहाँ पे interest rates हमारा जो होता expected वो होता somewhere around 4%. If COVID might not have come, but because of COVID, these interest rates have shot up. Correct? Now, from 3.5 trillion, if we have to go 5 trillion, what has to be done is in the economy is that economy growth has to sustain, economy has to grow, expansion has to be done. As we understood that most of the manufacturing units or most of the corporates are standing at somewhere around 80% of their capacity utilization. So that means they cannot add beyond 20%. At max, they can add 20% and the economy will come at stalemate. Economy will not move anywhere. There will not be any move because they cannot produce beyond 100%. So they have to start expansion, and to do expansion, they will start taking loans. When they start taking loans and interest rates are higher, they will not be able to repay. So economic rates have to come down. So RBI has to bring down interest rates so that economy can grow. And from this particular movement of the interest rates of fixed deposits, 12.5% to 5.5%, it is very much evident that whenever economy is growing, interest rates have to come down. And when interest rates come down, inflation will rise. So from here, we can draw a point that for our economy to grow from 3.5 trillion to 5 trillion, interest rates have to come down. That means right now we are standing at 7 to 8%, around 5 trillion. We might be somewhere around 4% or less than 4% rather. We will be less than, what happens? less than 4%. Anyhow, in coming 3-4 years, our interest rate will be less than 4%. So that means at that particular period of time, if I want to find something which is giving me 10% of interest or 8% of interest, it will be almost next to possible. Correct? Because when interest rates of a Reserve Bank of India is 4%, your bank FDs are at 4%, who is a fool to give you interest rates of 8% or 9%? Only a smart person will give you interest rate of 8%, 9%. Why that smart person? Because his or her company is having a investment grade below BBB minus. That means not suggestible for investment, which has a higher probability of default, and nobody is ready to give loan to that company, and that company is coming to you in the form of bonds कि भाई आप मुझे पैसा दे दो, I will give you 8% or 9% returns, right? Correct? So in this case, we will definitely not go with that particular investment instrument. We will choose something which is having higher. Now let's say this Mudaksh is having a AAA rating, correct? Now this has a maturity in 2030, so this will be available. Since its coupon rate will not change, that means interest which will be credited to the account will be 9%. In any case, this will not change, correct? Maturity will not change. Maturity will be 2030, because this is a contract which I have issued and signed, and I am liable and bound to this contract till my company is in sound condition. As soon as my company goes bankrupt, then whatever the residual is, that will be paid to the bondholders. But till my company is doing good business, I have to fulfill the commitments with this bond, irrespective of what market is doing. That is not the concern of the investor. So now, when we as a retail investor can understand that this repo rate has to come down somewhere around this percent, definitely big boys also understand. Correct? In bank, if you go, you can find a FD which is giving you 7 to 8% of return only maximum till 3 years. Beyond 3 years, it has a lesser rate. That means this FD rate also you can get only for 3 years in the bank. Here it is promising you for another 7 years. Let's say, for the sake of simplicity, let's say the maturity is 2033. That means for 10 years, this bond is guaranteeing that 9% interest rate will be there. So what happens is popularity of this instrument will rise. In this case, the popularity rise, so your premium starts rising. Right? Let's say, take an example, Suraj bought this bond, has this bond.
The premium goes out
Sorry,
rises because of higher coupon rate compared to the interest rates
पहली
on
तेरी
the
आवाज नहीं आ रही है
else we are not getting your voice clearly.
Am I audible now?
Now very much clear. Tell me.
So I was saying the premium rises because the coupon rate is greater than the interest rates prevalent in the economy, right?
Correct.
Okay.
So I'm explaining that particular example. Let's say Suraj bought this bond in 2023, correct? At the rate of 9%, and premium he paid was, let's say 70,000. अपने example में लेते हैं. This is the premium Suraj paid, correct? Now in 2024, March 2024, our repo rates is repo in 2024 April. This is, let's say, right now repo is, we are taking at 7%. Let's say repo is 6.5% or 6% for that matter. 1% नीचे आ गया, let's say that. Okay. So now when the repo has come down, Elster, being a smart person, understands the investments, and he understood that interest rates are coming down and they will go further down. And this bond is having a maturity of 2033 and confirming 9% coupon rate. Present yield is 8%. Let me buy this. So he went to Suraj and said, I want to buy this particular bond from you. Suraj said, okay, I will sell this bond at 11,40,000 to you. That means Suraj is charging how much premium? 1.4 lakhs. Am I right? Now Elster calculated, if he pays 1.4 lakhs, then his yield will drop by somewhere another 1%. So he'll be getting yield of 7%. considering rest everything remains same. So he'll be getting yield of 7%. Repo rate right now is 6%. He saw this thing from 7.5%. That means in a year, repo rate has fell down by 1.5%. And being an you can say active investor, he understands that in another 2 years, this repo rate would be somewhere around 4%. This will fall to 4%, correct? Or maybe below. In that case, his yield would be 7% in any case, and he will be having higher premium, because unless he gets higher yield compared to repo rate, he will not buy this bond. So Suraj is also smart to sell this bond at 1,40,000, which is placing 1% yield higher than the repo rate. So Suraj is also happy to have extra premium, and Elster is also happy to keep this. Now Elster is keeping this bond till, let's say, 2027, where economy touched down 5 trillion, and your repo rate has come down to, let's say, 5%. Another 1% has come, or for that matter, 4.75%, right? So here again, now let's say Shireen ma'am, she has just exchanged her couple of goods downstairs, and now she has good funds in her account by the 27, and she wants to buy this bond, considering the economy. Okay, let me invest in this amount, and I'll be getting 9% of coupon. So she went to Elster and bought this bond. Elster said, okay, I will be selling it at the rate of, let's say, 12,10,000. Another 70,000 premium. Let's say this another 70,000 premium, though the amount of maturity is less, but again, just for the sake of simplicity, understand that yield came down to
6%.
5.5%.
5.5%.
Right? Yield came down to 5.5%. Though the coupon which will be credited to her account would still be 9%, that means still be 90,000, but her yield has come down to 5.5% because she has given 2.11 lakh ka premium extra, right? But still she will be getting higher than the economy, and she understands very well that by the time it comes 2033, what will happen is repo rate will be somewhere around 2%, but still she will be getting 5.5%. Right? This is clear. So she will be getting at higher rate, and she knows this thing ki in case if she has to sell in between, then like Suraj and Elster, she'll also have an advantage of getting premium back. Correct? So she will keep this thing in mind and she'll buy it. Now, here the thing is ki with respect to the repo rate, we have understood why the bonds which have a higher interest rate or coupon rate and a higher credit rating, they are favored, and their premium and discount changes with respect to the repo rate. If repo rate rises, their demand will reduce. If repo rate reduces, their demand will increase. In that case, premium and discount changes. Now, since we have been discussing about the bonds that your face value remains constant, your coupon rate remains constant, your maturity remains constant, nothing changes except the yield. But with respect to the taxation, you will be taxed two things. So Suraj will be taxed here two things. One is that he has got 90,000 rupees ka income. That will be his income, which will be liable for tax. Second thing is a capital appreciation. Long-term capital gain, short-term capital gain. Because whatever capital he infused, that got appreciated because of the economic condition. So here, Suraj has got 70,000 extra. Correct? Instead of 10 lakh 70,000, he got 11 lakh 40,000. So 70,000 extra he has got. That is a capital appreciation in this case. So it is a short-term capital, because when capital appreciation we talk about, so it can be divided into two categories: long-term capital gain and another is short-term capital gain. Right? So long-term capital gain, since we are still discussing only debt category, it means more than 3 years. And short-term capital gain simply means less than 3 years. So here, though just for your information, recently government has changes the norms also. Now this is also going to your income directly. It is not getting taxed separately. But previously it was taxed separately. So beyond 3 years, you had the benefit of indexation,
Yeah.
which has now gone out for debt side. Here, no indexation.
Sir, can you explain this benefit, this term indexation, please?
I will. Don't worry. So this was the benefit on debt side if you're holding any debt instrument for 3 years or more. So whatever capital gain you are making out of it, that capital gain will be considered as the long-term capital gain. So debt instrument also says in this case that any real estate property also, if you have bought, may it be commercial, may it be your residential, or may it be any real estate property which you have kept it for more than 3 years, you can take the benefit of indexation. First, understand that here you will be taxed two things. First is your income, which is 90K per annum, right? So they will be taxed, and this will goes directly to your slab. Slab rate पे tax होगा ये. And अगर capital gain है, any capital gain, this will be taxed separately. So अगर capital gain है तो इसका taxation separate होगा, इसका taxation separate होगा, दोनों मिला के होंगे. Let's say from slab rate you are at 30% rate, so 30% of 90,000 is how much?
10%,
27. So
27.
90 minus 27, 27 would be your taxation. So 27 is tax over here. Let's say from capital gain you make 70,000. Correct? 70,000 is, let's say, taxed at 10% of the capital gain, long-term capital. Right now, I'm applying the capital gain
So,
of.
sir, 1 minute. So am I audible?
Yeah, you're audible. Tell me.
So the 90,000 is included in my income, right? So my income as a whole is calculated in the slab, not just the 90K, right?
Not just the 90K, all your income will be calculated. So right now I'm
Okay,
saying
sir.
whatever your income was being, let's say over here, again, put it more, your income is X and your tax is equals to 0.3x. This is your tax from income. Then income from bond is 90K per annum. Your slab rate के हिसाब से it is 27, because 30% tax अगर आपके income पे already लग रहा है, तो that means your bond income is extra over and above it. This will also go under 30% bracket. So 27 you have to pay. So what is your tax still over here? Then you have third component, which is your capital gain. Right now I am taking tax rate of equities, which is 10% for long-term capital gain and 15% for short-term capital gain, right? Because debt is considered for the indexation part. So indexation I will explain. Till then I'm just explaining you in a different way. So here Suraj got a 70,000 of capital gain. Let's say that capital gain was long-term, and long-term is being charged at the rate of 10%. So it will be how much? 7,000. So 7K from here, right? So total tax would be 27 plus 7, 34.
34. Yeah.
34 plus 0.3x. So total tax which Suraj pays is equals to 0.3x
The other income ka tax.
plus 27K plus 7. So 0.3x is whatever your salary or your income, your primary income, whatever you are having, that is your income, that is 0.3x. 27 from bonds, interest income, and 7 is the capital gain. So capital gain is charged tax differently. This fundamental,
Okay.
this funda is clear how to calculate the tax. This is clear
Yes, sir.
to everyone? Elster, Ayan,
Yes,
Shri
sir.
ma'am?
Yes, sir.
Ananya
Sir,
ma'am?
didn't you?
Yeah, tell me.
So can you explain the difference between the 0.3 and the 27?
So they here actually I've taken X. So let's say you are earning 10 lakhs. Your salary is 10 lakhs and everything is taxed. So we have brackets, but let's say everything is being taxed and your salary is 10 lakhs. So here you have paid tax of 3 lakhs,
Yes, sir.
right? So you have this is your salary. Let's put it as a salary income, right? This is your salary income of 10 lakhs. you paid a tax of 30%, which is 3 lakhs. So this is the tax on salary income. Then you had bond, which is your investment. So investment has two gains to you. One is your income, so which is 90,000 as an interest. So on 90,000 interest, you have to pay 27,000 of tax because your tax slab is 30%.
Okay, okay, got it.
Got it? And third is
I
the
thought,
capital.
okay, I thought it would be 10 lakhs plus
Uh-huh.
90,000.
Correct. So your total income would be 10 lakhs 90,000 plus 70,000 of capital gain. So this is though your income, but it is treated differently because income tax says that you will be treated differently for different sources of income.
Yes, sir, got it.
Got it? So it is treated differently. That's why these three different. So here you can directly calculate 10 lakh 90,000 and you will come out to 3.27 lakhs of interest. That you can do it directly. That actually is done directly. Your 90,000 is added. Just to illustrate, I have taken it separately.
Okay, sir, got it.
Got it? Okay. So now this part is clear how tax is calculated.
Yes, sir.
Correct. Now what happens is that when we talk about the debt part, the 10% which I have taken over here is actually taxation on equities. If you keep any equity there, your time period is also 1 year. If you keep any equity or equity instrument for more than 1 year, that gain is called as capital gain, long-term capital gain, and you are taxed at 10%. But in debt, what happens is this tax was, I'm using this word was because recently there has been a change in the norm that anything which is having more than 65% of equity in their instrument, that only will be getting as benefit of indexation. Otherwise, you will not get benefit of indexation. So the debt instruments which were having target maturity of more than 3 years, they were popular amongst the investors because they were getting indexation benefit. Now it is not popular because it has indexation benefit has gone off. Now what exactly indexation benefit is? First of all, indexation benefit is nothing but it deals with inflation. Now just answer a very simple question. Let's say 3 years back, if I have given you 100 rupees, at that time you were able to buy let's say 5 kgs of tomatoes, right? I gave you 100 rupees. You said ki, okay, I will not buy 5 kgs of tomatoes as of now because I don't want it. What I will do is I'll just go and keep these tomatoes, keep this 100 rupees in my piggy bank because amount is very small. So piggy bank is a decent word to use over here. And after 3 years, in 2023, you just went, since you want to buy tomatoes, you went out and you went in and you took out that 100 rupees and you went to buy tomatoes. And you were surprised that instead of 5 kgs, you are not even able to get 1 kg. You are getting only half kg. So where you are still having 100 rupees, you had 100 rupees at that time also, your 100 rupees has not changed, that note has not changed, the value of 100 rupees not changed. You're still able to buy 100 rupees because RBI guarantees you to give 100 rupees, right? The thing is, the purchasing power of that 100 rupees is reduced. Why? Because of inflation. Inflation has reduced the purchasing power of that 100 rupees. Now this inflation has impacted your purchasing quantity also. So government or income tax department says ki whatever you have bought, and if you are making money, now take this example ki let's say you have bought that what you call it 5 kgs tomatoes at that time, and for the sake of understanding, let's say that you have bought those 5 kgs tomatoes and you can keep those 5 kgs tomatoes for 100 years. And you saw that 1 kg tomato right now is costing 200 rupees kgs. You took out those 5 kgs tomatoes out of your let's say lockers and you start selling. So you bought those tomatoes at 100 rupees or 20 rupees per kg, but now you are selling at 200 rupees per kg. That means you are making how much money? 10 times. So your
180 rupees.
so your 100 rupees investment has now turned to 1000 rupees of return. Correct?
Yeah.
So technically, how much money you made? You made 900 rupees. If your tax slab is 30%, so if on 900 rupees, how much money you have to pay as a tax? 270 rupees.
Yeah, 30%, yes.
30%, 270 rupees of tax. So 900 minus 270 is how much? 630 rupees. So yes, Alistair, tell me.
So I couldn't hear you very well. Can you repeat the example?
Okay.
My
So
internet kept.
no issues, no issues. I'll keep on writing. So 2020, you bought 5 kg tomatoes. Spelling could be wrong. Spelling was wrong. At 100 rupees or at 20 rupees per kg. 20 per kg, right? 2023, you sold those tomatoes at 200 rupees per kg.
Yes,
Is it
sir.
okay?
Yes, sir.
Right? So total investment equals to 100.
Yes, sir.
Final return equals to 1000. Total gain is equals to 900,
900.
right?
Yeah.
Tax is equals to 900 multiplied by 0.3, 30% slab, which is equals to 270. Net gain post tax is equals to how much? 630,
Yeah.
right?
Yes, sir.
Now,
Yes, sir.
now tell me, will you be able to buy in 630? Will you be able to buy 5 kgs of tomatoes? No,
No.
right? So basically, in 3 years, what happened is the inflation rose very much. Because of that, you were able to earn so much. But again, you have earned, and since it is not what you can say a fair decision to charge you 30% tax on what you bought it 3 years back, right? Because 3 years inflation was less. So what income tax department says that we will adjust inflation in your buying price. We will give you advantage to adjust inflation so that your taxable income reduces. Here our taxable income is 900 rupees, which is selling price minus buying price. Correct? Now income tax says that you can adjust this particular inflation in your buying price. So you bought at your buying price is 100, right? Every year income tax department comes out with an indexation number which is published on their site. You can use that indexation number. There's a small calculation which I'll tell you in the next class how that calculation is done. With that calculation, there's you can add on to your buying price. So let's say for these 3 years we got some indexation number, and that indexation number after calculation comes out to be 300, right? So our new buying price is equals to 100, which is our original buying price, plus 300, which becomes 400. This is our new buying price, right? Correct? So now our selling price is equals to how much? 1000. That does not change. Total earning or income is equals to 1000 minus 400, which will be 600. Now I will be taxed on 600, not on 900. So my tax would be 600 multiplied by 0.3, which is equals to 180. Net income is equals to how much? 180 if I reduce it to 420.
90.
Correct? Though this 300 is also in my hand, right? So I have paid only 180. If I do a net calculation, I got 1000 rupees and I paid 180 rupees as a tax. So how much effectively is left in my hand? 820.
Yeah.
Whereas in the previous case, how much I was getting? 1000
630.
630.
minus 270, which was 730, not 630. 730 मेरे हाथ में नेट आ रहा है because 100 रुपए जो इन्वेस्ट किए वो भी तो वापस आएगा. 630 was net earning, net
Yeah.
gain. So यहाँ पे net gain जो है वो 420 हो गया post indexation. Effectively net gain is 720. Correct? Because 300 जो indexation का था वो भी add हुआ. Right? So here here I'm getting 820 in my hand, here I'm getting 730. If I did not get indexation benefit, I got 730 as a disposable income in my hand. If I get the benefit of indexation, I get 820 in my hand. So this is how indexation helps. Now indexation rules have changed. So on real estate, you get indexation. If you bought any property at 1 crore at, let's say, 5 years back, and today you are selling that property at let's say 2 crores, so you don't have to pay tax on 1 crore. With indexation, your costing might have gone from 1 crore to 1.5 or 1.6 crores. So you might have to pay tax on only 50 lakhs or 40 lakhs of gain, because government says, or income tax says, that your effective cost, like in yield, what happens is effective returns. Here, your effective cost of buying goes up because inflation is added. Inflation has actually reduced the power of your purchasing. So that is added to your buying cost, and effectively the selling cost is being considered, and your taxable income is considered. This is how indexation plays a role. Clear?
सर गोल्ड इज आल्सो
नहीं,
गोल्ड नहीं है, गोल्ड पे नहीं इंडेक्सेशन
gold penny. Only debt instruments and real estate.
ओके
And that too beyond 3 years. Now debt instrument की definition में थोड़ा सा government ने modification किया है. तो government says anything which has a equity component into it for more than 65%, that will be considered as a debt instrument, or sorry, between 35 to 65%. So now you will see a new category of funds. अगर mutual funds का track करते हो तो there is a new category of fund which is coming as multi-asset. So in that there should be a component of equity, there should be a component of debt, there should be a component of what you call as commodities, gold and silver. So these three components should be there in that particular instrument. Then only that will be considered for indexation benefit. Government has changed the definition a little bit. So that has become a little complicated, which we'll understand in the next class. But this is how indexation benefit gives you to reduce your taxable income. Got it? Clear to everyone?
यस सर
Ayan, Elsewhere,
Yes, sir. Yes, sir.
Shreen ma'am,
Yes, sir.
chalo, done. So rest we'll do in the next class. Today is your Sunday. Enjoy your day. Though already half a day has been gone because of me or my class.
No, sir, not
Because
really.
of the workshop,
Because of the
which was
workshop.
not even worth it.
Not even worth it. Why?
Sir,
Okay,
if you stop the recording.
wait. Exactly. This is what I'm saying. Wait.